Hi everyone. Today the topic of our presentation is IAS 33 earning per share. The content of presentation are introduction, objectives, scope, definition, importance, calculation, disclosure, summary. So let's start with the introduction. Introduction to IAS 33. IAS 33 earning per share is an international accounting standard issued by International Accounting Standard Board. It focuses on how earning per share should be calculated, presented in financial statement. EPS is a key indicator of financial performance because it links profit to the number of ordinary shares outstanding. Since company may have different capital structure, IAS 33 ensure that EPS figures are comparable and not misleading to users of financial statements. Objectives. The main objectives of IAS 33 is to improve comparability of financial statement among entities and across reporting period. It aims to ensure that profit attributed to ordinary equity holder is measured accurately by requiring both basic and diluted EPS. The standard provides a clearer picture of current performance as well as potential future dilution of earnings. Scope of IAS 33. IAS 33 applies to entities whose ordinary shares are publicly traded or are in the process of being issued in public market. It also applies when an entity voluntarily presents EPS. The standard focus only on ordinary shares and instruments that can potentially be converted into ordinary shares. Preference shares are excluded unless they affect earning attributable to ordinary shareholders. Key definitions. Earning per share refers to profit or loss attributable to ordinary shareholders divided by weighted average number of ordinary shares outstanding. Ordinary shares are equity instruments that rank after all other classes of equity. Potential ordinary shares are financial instruments or contracts that may entitle holders to ordinary shares in the future. Dilution occur when these instruments reduce EPS upon conversion. Importance of IAS 33. IAS 33 is important because EPS is one of the most widely used performance measures in financial analysis. Investors use EPS to evaluate profitability, growth, trends, and investment returns. Accurate EPS reporting enhances investor confidence, improves transparency, and supports fair valuation of shares in capital market. Types of earning per shares. Basic earning per share, diluted earning per share, both must be presented if the entity has potential ordinary shares. IAS 33 requires two types of EPS. Basic EPS reflect earning based solely on existing shares, while diluted EPS reflect the impact of potential ordinary share. Presenting both figures ensure that user understand not only current performance but also the possible effect of future share conversion. Basic earning per shares. Basic earning per share measure earnings attributable to ordinary shareholders using the weighted average number of ordinary shares outstanding during the reporting period. It ignores potential ordinary shares and provide a clear picture of earning based on the current capital structure. This measure is useful for assessing current profitability. Calculation of basic EPS. The calculation of basic EPS involves two key components, the numerator and the denominator. The numerator is profit or loss attributable to ordinary shareholder after deducting preference dividends. The denominator is the weighted average number of ordinary shares outstanding adjusted for share issue or buyback during the period. The weightage ensures a fair reflection of shares in circulation. Diluted EPS. Diluted EPS represent earning per share assuming all dilutive potential ordinary shares are converted into ordinary shares. It shows the minimum earning per share that could be reported. This measure is particularly used for assessing the risk of dilution faced by existing shareholders. Potential ordinary shares. Potential ordinary shares include instruments such as the convertible bonds, convertible preference shares, share option warrants, and contingently issuable shares. These instruments are considered in diluted EPS only if their conversion will decrease EPS or increase loss per share. Anti-dilutive instruments are excluded to avoid misleading results. Calculation of diluted EPS. To calculate diluted EPS, the profit figure is adjusted for interest, dividend, and tax effect related to dilutive instrument. The number of shares is also adjusted assuming full conversion of potential ordinary shares. The calculation must be performed sequentially from most dilutive to least dilutive instrument to ensure accuracy. Presentation requirements. IAS 33 require both basic and diluted EPS to be presented on the face of statement of profit or loss. EPS must be shown for profit or loss from continuing operations and for total profit or loss. Comparative EPS figure for prior period must be disclosed to allow trend analysis. Disclosure requirements. Entities must disclose the earning amount used in EPS calculation and the weighted average number of shares used. They must also disclose information about instruments that could potentially dilute EPS in the future. Any significant changes in share capital after the reporting period must be explained. Summary. IAS 33 established a consistent framework for calculating and presenting earning per share. It enhanced transparency, ensured comparability, and support informed decision making. Both basic and diluted EPS provide valuable insight into an entity's profitability and capital structure. Thank you.